Signing a mortgage represents a decades-long risk allocation contract. Many first-time buyers fall into a specific psychological trap right at the start. They look at their current monthly rent, look at an identical estimated mortgage payment, and assume that because the numbers match, they can afford the home. That math ignores the entire baseline of homeownership. Renters never receive a separate bill for property taxes, they don't pay for local service charges, and they certainly don't pay for structural repairs when a pipe gives way in the basement. If your budget is perfectly calibrated to match your old rent, a sudden $5,000 out-of-pocket expense for a new heating system will immediately break your household finances. Rent is the absolute maximum you will pay for housing in a given month. A mortgage payment is the absolute minimum you will pay to access a long list of ownership liabilities. This scorecard illustrates the maximum approval limit danger. The bank inputs your income, credit score, and debt to fit their risk model, but they completely ignore your actual life, variable utilities, childcare costs, healthcare, job volatility, and emergency savings. Borrowing right up to the bank's maximum limit leaves zero financial buffer for those normal life events. When your income drops or expenses rise, you are forced to rely on high-interest credit cards just to survive the month. Eligibility is not affordability. The bank's calculation only determines if you can borrow the money. Only you can determine if you should live with that monthly pressure. The first lever is your interest rate. This comparison matrix shows why the rate structure matters more than the headline number. A fixed rate guarantees your core payment won't change for a set period, protecting your budget even if the market spikes. But that safety carries a hidden premium. The lender charges you for taking on that risk, and if you need to sell the house or refinance before the fixed term ends, you will face harsh, expensive early repayment penalties. A variable, or tracker rate, sits on the opposite end. It offers a lower starting rate right out of the gate, giving you flexibility to overpay without severe penalties. The danger is that you absorb 100% of the market risk. If benchmark interest rates go up, your required monthly payment will immediately spike with them. Choosing an interest rate comes down to choosing who holds the risk. You either pay the bank to hold it with a fixed rate, or gamble your own cash reserves for the flexibility of a variable rate. Your second lever is term length. This trade-off triangle maps out how extending your loan from 15 to 30 years manipulates cash flow. Spreading out repayment over 30 years drops your monthly payments significantly, creating immediate breathing room in your budget. You pay heavily for that breathing room. Because the principal balance drops so slowly, the bank charges you interest on a large sum for decades. You end up adding tens of thousands of dollars in extra lifetime interest. A 15-year term forces a rapid buildup of equity. You clear the principal faster and save a massive amount on total interest paid to the lender. But that aggressive, high monthly payment locks up your cash flow. If you lose your job or face a medical emergency, you still have to meet that high payment every single month. A lower monthly payment is not a discount. It is an expensive financing fee you accept to buy yourself time, and it heavily increases the true cost of the home. The third lever is your deposit and loan-to-value ratio. This chart plots the tension between tying your cash up versus keeping it liquid. A common strategy is to max out your deposit, putting 20% down to lower your monthly payment. If you drain 100% of your savings to hit that 20% threshold, you enter the home financially fragile. You will have zero emergency funds to cover day-one moving costs or sudden repairs. Alternatively, making a minimum deposit, say 5% down, preserves a strong emergency fund in your bank account. But keeping that cash means you take on a larger loan. You accept higher interest rates, you pay for mortgage insurance, and if property values drop, you risk falling into negative equity, where you owe more than the house is worth. The ideal balance sits in the upper right quadrant. By purchasing a slightly less expensive house, you can afford to put down a solid deposit while still protecting a healthy cash emergency fund. Home equity protects your balance sheet on paper. Liquid cash protects you from going bankrupt next month. To survive homeownership, you need both. Before you look at a single property, you need to identify your primary financial constraint. This decision tree maps the math directly to your real life. If you are a first-time buyer with tight cash flow, prioritize a longer loan term paired with a fixed rate. This gives you budgeting safety. Just ensure the contract allows penalty-free overpayments so you can reduce the debt when your income grows. If you are a freelancer or commission earner with variable income, you must purchase drastically below your maximum approval. You need high cash reserves so your baseline payment remains survivable during a bad earning year. If you have strong reserves and want to optimize wealth, you can aggressively kill the debt. Utilizing a shorter term or a flexible variable rate allows you to pay the principal down fast and achieve the lowest total lifetime cost. There is no universal best mortgage product on the market. There is only the exact mathematical combination that absorbs the specific risks of your unique lifestyle. Your mortgage decision should never be driven by the bank's willingness to lend. It must be driven entirely by your capacity to absorb pressure over the next few decades. Calculate your affordable payment based on your worst realistic month, not your best month. Property appreciation is a potential bonus. Relying on rising home values to magically fix an unaffordable, maxed-out mortgage is a direct path to default. The absolute strongest negotiating position any buyer can have is a strict internal budget and the willingness to walk away from an overpriced house. The perfect mortgage isn't the one with the biggest approval number or the lowest initial rate. It's the one that leaves you with enough money to actually enjoy the life you're building inside that house.